In this screencast, we will look at special orders and make or buy decisions. Special orders refer to opportunities to make additional units of a product that are sold outside the normal distribution channels. Make or buy decisions occur when a company considers outsourcing elements of its production process. In this example, MCM is considering selling 8,000 chairs without its brand name attached, that is, with a white or blank label. The chairs sell at a discount, but otherwise it is assumed MCM can still make and sell its normal production schedule. If we compare the current case with the special order, we see the contribution margin from white label sales is equal to 8,000 times the sales price per unit minus the variable cost per unit. Net income increases by $280,000. Now the problem is complicated that the white label order would take MCM beyond its production capacity. There are several ways to analyze this case, but I prefer to lay out the base case and then adjust to meet conditions. One adjustment is the increase in contribution margin from white label sales, $525,000. The other adjustment is to recognize the loss in contribution margin from regular sales in order to satisfy the capacity constraint. That is, 5,000 fewer normal units would be produced and sold in order to meet the demand of the white label sales. Overall, contribution margin and net income increases by $250,000. MCM must evaluate whether to continue to buy rubber wheels or make them in-house. The cost of in-house production for 800,000 units is budgeted. It turns out it's cheaper to make than to buy. In this case, we consider the implications of a 10% spoilage rate when Travel Stuff makes the wheels in-house. A 10% spoilage rate means that units produced times 90% equals units available for use. Approximately 889,000 units wheels need to be produced in order to yield 800,000 good wheels. The budget is scheduled for production of 889,000 wheels. Note that fixed costs remain constant. A new wrinkle is the recognition that making the wheels in-house will impose a capacity constraint. We will ignore the spoilage concerns from the last example. The capacity constraint implies 1. That an opportunity loss of $1.24 million will be incurred, and 2. 80,000 fewer wheels need to be produced. To see all the effects, I use the device of a hypothetical contribution margin to serve as a base case. The net contribution margin when the wheels are bought externally is $1.2 million. Starting now with the base case, we'll work through all the costs of productions for 720,000 wheels. Note the loss contribution margin we recognized earlier. When we've worked through the budget, we see that the total contribution margin of making the wheels in-house is a reduction of $424,000. This is a simple example of evaluating the impact on income of closing a division. The base case is a loss of $200,000. If the division is sold, contribution margin goes to zero, but some of the fixed costs are not avoidable and remain. In the end, the one-period effect is that discontinuing the division decreases net income. This is a more complicated example of a problem similar to the previous exercise. Once again, all contribution margin related to the product is lost. Fixed manufacturing costs are avoidable and therefore can be saved. However, only 1/2 of the fixed operating costs can be avoided. The sale of the assets could result in either a gain or a loss, but that would depend upon their net book value at the time of sale. Dealing with this gain or loss correctly would require a multi-period NPV calculation that is beyond the scope of this course.